Hello there and welcome to the week starter edition of News Express right here on Africa Business Radio, exclusively brought to you by Business AM, Nigeria's fastest growing financial and business newspaper. I am Rachel and I'll be taking you through the week's headlines on Business AM this morning. Top in the front page of the paper, AFCFTA, Southern Africa's $53 billion export potential puts it in pole position. And bullet headlines just beneath that, Nigeria and West Africa in distant third. With just $9.5 billion, we have South Africa accounting for 80% of southern regions on tap. North Africa comes with $13.4 billion, West $9.5 billion, East $7.8 billion, Central last with only $814 million. And the last one there says, if tapped, total intra-African trade could hit $231 billion. That's a lot. Check out that headline here on the front page. Just below that one now, Nigeria's banks hold ground in $8.61 billion capital imports. On the foreign toppers chart, we have Standard Chartered with $2.5 billion. We have Stanbic IBTC with $20 billion and Citibank with $1.7 billion. And on the Nigerian toppers chart, we have First Bank, $798 million. Access Bank, $312 million. Zenith, $144 million. And GT, $110 million. Of course, you want to check out the breakdown of those numbers on the headline right here. And then moving to the summary section, WEF highlights recovery roadmap. On the finance and investment, we have CBN in market deepening move. Emo to partner hospitality sector. MTN faces first quarter 2021 headwind and the food inflation crisis. Catch all of that on pages 4, 10, 27, 30 and 22 of Business AM. And now joining me for conversations on the headlines this morning is the publisher, Business AM, Mr. Philip Isakwa. Good morning, Mr. Philip. Thank you for joining us this morning.
Good morning, Rachel. Thank you for having me.
Right. Now, I am particularly interested in the headline on page 4. That headline gives detail of what went down during the 5th annual meeting of the Economic Zones Organization. And we saw the AFDB President, that's the person of Akinwumi Adesina, giving a clear comparison between Chinese special economic zones and that of Africa as well. Now, give us a clearer picture of why it is Africa seems to be losing out from, fully participating in that $3.5 trillion global special economic zones market, and what really can be done differently.
Rachel, you will understand that special economic zones are created normally, for the purpose, main purpose of enhancing business and economic growth. We have zones in Nigeria, for instance. We have the export processing zones in Lekki. You have in Port Harcourt. You have, I think, in some other places. I think Olokola was one that was being touted in Ogun State some time ago. It hasn't fully developed. And if you really take the Nigerian situation as a way of looking at the African continent, you will look at the plan to do something at Olokola. Some years ago, British Gas came in, wanted to set up in that location, so that they could take advantage of the special economic zone that was created, but nothing happened. Infrastructure is a big problem in the economic zones of Ogun State generally. Agbara is problematic in terms of infrastructure, road network, you have electricity problem, and so on and so forth. Recall, if you take the big Dangote refinery and petrochemicals that we're talking about that is going on right now in Lekki, those who will remember, if you take their mind back, they will recall that it was meant to be set up in Ogun State, but I guess maybe the competition for investors got Lagos State agitated and was able to attract Dangote to relocate to Lekki. But the key thing is about infrastructure. There's another deep sea port that is planned for Badagry. Again, it's not taking off as smoothly as you want it to go because of infrastructure. So basically, the Chinese have mastered the craft. The Chinese are called the manufacturing complex of the world, manufacturing for different parts of the world. We go to China to import, a lot of things that have been produced, manufactured. But that's because the setup there makes it very easy. So if you create an economic zone, you need to, government needs to be involved, strongly, So you talk about finance. It's difficult to raise finance for such big, huge projects. You talk about institutional gaps, which were identified as these are things that were identified as constraining Africa's participation in a $3.5 trillion global market.
Right.
So those are the issues. Africa needs to tackle its economic and financial problem with a global mindset, and be concerned about competitiveness, So competitiveness will mean that your infrastructure is good, your ability to raise finance and is excellent.
Exactly.
The institutional gaps that exist, for instance, whether it's political or legal, and supporting institutional arrangements, must be put in place in such a way that they make these zones viable, welcoming. Recall too, we had one in Calabar. The whole notion of Tinapa was built around an economic zone. And the Tinapa was partly killed, because an economic zone, became something else. You had the customs go in there, and you could not differentiate between what was an export processing zone and what was things that what was produced in country. So those are the issues. Africa needs to look at its economic problem, from a global mindset, and think competitively. You have a market that is 3.5 trillion. Again, we have this with regards to internal trading, so trade amongst African countries, and that's why we talk about the African free trade zone, free trade area, that we hope that will come into effect in 2021 January. And when it kicks off, we hope that things can begin to normalize, and that they can begin to think more competitively and see the benefits in partaking in what is a global market that needs needs to be taken.
Right. Now let's move away from that story now, but still on the same page 4, we find the annual report by ratings agency Moody's, and that report indicates that the country's deficit will remain high and that debt levels will continue to rise quickly, albeit from the moderate level. But then again, if you move down in that headline and that story, the report states instances where the B2 negative outlook could likely move to stable. Bring us up to speed with that.
Okay, so you have these global rating agencies. Moody's is one. S&P, Standard & Poor's, is the other, and I think there's one other one. So they come up with a global ratings. Nigeria is a big player globally. We might not have all that we need to play real big, in global economics, but it's a big market. Nigeria is a big market, so people are going to be watching out what's going on in Nigeria. So Moody's focuses on Nigeria, when it does its annual report. And here we are looking at, I think it's about the credit profile. This rating has to do with credit, and a lot of things go into play when the international agents or global agencies are doing ratings regarding credit. One is to look at the Nigeria's deficits and Nigeria's debt. The deficit, of course, we've been having a annual budget for the past how many years. That has been based, that has always been deficit based budgeting. The one for 2021 is already a deficit budget. We are scrambling all over the place to see how we can, where we can get money to deal with the deficits ahead.
Yes.
2020 is not over, but we are still struggling to close the deficit gap if we ever get to do that. In 2019, the same thing. I think 2018 as well. So. If you can cite an example. If you go to America, and then an election is being held, one of the major things that they talk about is what government, or whether it's Democrats or whether it's Republicans, will be able to close the budget. You understand? The deficit, if there's a deficit, we talk about what is best. Of course, some economics would say a deficit budget isn't bad idea as long as the deficit is used productively, But you can also talk about a balanced budget. You can also talk about a budget that is running into surplus. Those two are positive, in terms of the psychological, the psychological way you look at it, So now they are looking at credit rating and they said our budget our deficit has been growing and it will continue to grow. And this on the back of oil shocks. There's no clear signal yet, about how oil prices are going to go. Whether they're going to keep moderating as they have been, or with the second wave of COVID-19 happening in Europe and America, we don't know what we're going into the colder winter. January is going to be really cold, and so we don't know what COVID-19 is going to do to the economies of Europe and America. The United Kingdom is already talking about a new strain of the virus, which has shut down London. So the key thing is that with COVID-19, with oil shocks, the budget, our deficit, it believes. Moody is saying it's not going to come down. It's going to remain high because we're going to be short of cash. We're going to be short of money, to close the holes. So they're suggesting that, and then they're talking about a debt crisis. Of course, we talk about debt to GDP ratio. We talk about, the GMO will assure us that there's nothing to worry about. A debt to GDP ratio is still comfortable. The Ministry of Finance will say our debt to GDP ratio is still comfortable, but it is high. And more debts are coming in. The World Bank is giving us money. We are leveraged. I don't know whether we are leveraged, but we are leveraged to China. In such a way that we don't know what might happen if we are unable to pay back. So debt is going to be high. Continue to be high. It's going to pile up. So we're going to always look for money to close the gap. Whether money comes from raising bonds, or I don't know whether we're going back to the euro bond market. But we're going to continue to look for money to close the gap. And if we're going to continue to look for money, it means It means the debt profile will continue to rise. Don't forget that we don't know what will happen in 2021. Of course, 2020 has been a bad year for everybody, for the whole world. Vaccines have come out from Pfizer and Moderna and the rest of the others who are still trying to put their own together. But we don't know what will happen in the whole of 2021. There are people who say that COVID-19 will continue to run even up to September, that autumn next year, and if that continues, it means the global supply chain is going to continue to be affected. And if that happens in terms of its negative impact on oil prices, whether including oil prices that is replaced by demand and supply, mainly demand. If demand continues to be down, then we're still going to be in a hole, and we will need to dig ourselves out of that hole.
Right.
So that's it with what this Moody's report is talking about.
So should we expect this not so bright, not so positive reports to affect trading this week, seeing that the bulls, retained their grip on the markets all through last week?
I guess, Rachel, some other factors are actually at play, at the market. We don't particularly know why this. Okay, top of my head is that this will not have any particular impact on the market.
Okay.
Because although we've had what they call deficit has been there for the past 3, 4, 5 years. What they call our debt profile has been growing. Even the debts that have been taken on, in the last. So in 2020 alone, they've been there, and they particularly didn't have impact on the market. So it's not going to affect. Some other things are driving that market, and sometimes we talk about profit taking. We talk about the fundamentals that are driven, fundamentals like what we call earnings report. If you have the big players who really shape influence the market, the banking sector, for instance, the reports have been good. And then you have what you call the interest, the yield environment in fixed income. That hasn't been particularly impressive for some time now. Since I think they banned local interest in treasury bills, or OMO auction. You've had a situation where that market has gradually become unattractive. So money has been going to the capital market. You have the fund managers for instance, pension fund managers who look for safe havens for the money that they are keeping, in the capital market. So those are the things that are influencing the market, and not necessarily this Moody's report that came out over last week.
Right, so we'll just wait and see what the market looks like today and for the rest of the week. Just before I let you go, in just 2 minutes, because we're short of time, in just 2 minutes, please take readers through any other headline you'd want them to look into this week.
I think one of the things to look out for is what the government, the CBN is doing regarding this new, just call it, the CBN is trying to deepen the financial markets, and over the weekend they introduced quite a lot of things. Thursday, Friday, and they're coming in through the non-interest window, so they released some some framework. First, they released a framework on how to participate in what they call a non-interest asset class, So, and then the next time they came up with another clarification, a clearer stuff that says non-interest asset-backed securities, issued this framework. So we're expecting, when these things come out, I believe the CBN came out with this over on Friday, Thursday, Friday, so that participants could chew on them, so that this week they can come back and see how they can participate. But it follows the Sharia investment opportunities that have been created for the market to look at. So I think it's good. It's keeping the market. A lot of for many years, the talk has been a shallow market without many instruments for money to go into. So if this is coming up now, it's a good idea, and we hope that. Again, let me quickly say that there's also the opportunity it creates, especially for non-interest financial institutions, and that they created a framework for participation at non-interest financial institutions. So we probably will see new ones coming, in that through that window, who are basically going to be for that purpose alone, and then you have the asset class called non-interest asset-backed securities.
Right.
So a lot to chew on this week from that CBN guideline.
All right. Thank you so much, Mr. Philip, for doing this with me today. We'll get back to you at the close of the week for a review of development stories and, of course, a preview of what to expect next week. Thank you once again.
Thank you very much, Rachel, and have a great day.
You too. Philip Isakwa is the publisher, Business AM, Nigeria's fastest growing financial and business newspaper. I'll take you into the markets in just a moment. Stay with us.